So yes, all roads lead to inflation. That's historically the way every civilization has gotten out, is they've inflated away their debts.
That was billionaire investor Paul Tudor Jones, who manages over $12 billion in assets and is a billionaire himself. As he explained in the short clip you just heard, he believes dark times lie ahead for the American economy, and the federal government is facing a serious crisis. Why? To understand, we have to start with a quick history lesson. We know that the U.S. federal government has been spending at unprecedented levels. If you've seen any of my recent videos, you know that since the late 1990s, the U.S. has consistently spent more than it earns, leading to a growing deficit. Today, that deficit stands at a staggering $36 trillion. However, deficits alone don't tell the full story. Most countries operate with some level of deficits, so the raw number isn't always meaningful by itself. Instead, economists compare it to the size and strength of the economy using a measure called the debt-to-GDP ratio. This ratio essentially indicates how burdened the country is by its debt relative to its economic output. Now, for the U.S., even after adjusting for the economic growth of the last 20 years, the country remains at historic debt-to-GDP levels. As of Q3 2024, the debt-to-GDP ratio stands at 120%, slightly below the pandemic peak, but still at levels not seen since World War II. Outside of major wars for national survival, the country has never faced a more challenging budget situation. Now, bringing it back to that Paul Tudor Jones interview, the actual mechanics of this current situation are worsened by a few major events that have occurred in the last 10 years. You see, at the end of the day, the only significant way a government can bring money in is through taxes. Because we are obviously facing a growing deficit every year, there is a major problem emerging that is plaguing the country. I don't want to bore you with tax talk, but just a brief explanation will set the tone for the rest of the video and showcase just how tense this budget situation really is. In 2017, the Trump administration passed the TCJA, or more commonly known as the Trump tax cuts. This law lowered taxes for most people and businesses. It cut corporate taxes from 35% to 21%, aiming to encourage businesses to invest and hire more workers. It reduced tax rates and doubled the standard deduction, meaning many people got to keep more of their paychecks. This is great news for us, but for the federal government, it's estimated that it costs nearly $450 billion in missed revenues every year. And the big news is that it's set to expire in 2025. Now in 2024, the government deficit was $1.83 trillion. Allowing the Trump tax cuts to expire would significantly reduce that yearly deficit. Now, let's hear what all this has to do with Paul Tudor Jones and his prediction. Take a listen.
Let's talk about taxes, though.
Okay.
Because that's how the money is going to get raised.
Correct.
One way or the other.
Correct.
I think we have a screen, if we could, that puts up a little bit of a menu here.
Yes.
Of, I don't know if it's options. Actually, they may not be options at all.
There are plenty of options. There are plenty of options.
There's not many ways to get where you need to go unless you start to do some of these things.
Correct.
Maybe. So the question is, of what's on the screen, you can let the tax cuts expire. That gets you
look, can I just say this?
Yep.
You have to let the tax cuts expire.
You have to.
Yeah, you have to let those expire. That's $390 billion. We're going to have, again, we're gonna be broke really quickly unless we get serious about dealing with our spending issues, and unless we can either, I don't know if we'll be able to cut spending that much. 60% of our spending are transfer payments.
But if you think we're going broke.
Remember, this is a billionaire speaking. Paul Tudor Jones points out that balancing the federal budget is going to be incredibly difficult because finding areas to cut spending is no easy task. While some people, including Elon Musk, may doubt this, the reality is clear when you look at where the money goes. The largest spending categories are things that people almost universally refuse to cut or simply can't be cut. Social Security, national defense, healthcare, Medicare, veterans benefits, and interest on the national debt. But given what was said earlier, there is a big problem with Paul's online or general statement. The guy coming into office is the guy who cut the taxes. Is he really prepared to let his own plan expire, given just how incredibly unpopular that move would be? And on top of this, the TCJA expiring wouldn't really fix the issue. You would need more sources of revenue just to stabilize the debt to GDP growth. Mr. Jones believes what is necessary on top of the cuts expiring is an additional 1% payroll tax on all workers, a bump in the corporate tax rate, and a 10% increase on individual taxes, pushing the top rate to just about 50%. And even that would be just enough to break even and stop the spiral from continuing. Take a listen to a shocking statement and pay close attention to the ending.
But if you think we're going broke, and you think Trump is going to be the president, he's not going to let those tax cuts expire if he can avoid it.
The thing
He does not want the corporate tax rate to go to 25%, as you're suggesting it'll have to. He's suggesting it should go to 15%.
I'm saying that just to get us to the point where we stabilize debt to GDP at where it is right now, here's what you need to do. You need to let the Trump tax cuts expire. That's $390 billion. You need to raise the payroll tax on every single working person, 1%. That's another big slug. You need to...
What do you think that does to jobs?
We're clearly going to have a period of contraction, which hopefully, that's why I was going to say, it's going to be really important for the Fed to be able to offset the fiscal contraction area that's going to come.
Then you want to increase the individual tax rate all the way to a top rate of close to 50%.
Now, hold it.
Yep.
I don't want to do any of this stuff. What I'm telling you is that we've got to be serious about where we are fiscally. And so I'm giving you, there's a whole set of options, right? We could go in and cut 25% of the federal workforce. Some people may do that. There's a website where you can go look and play with all the options. You can raise the capital gains rate from 21 to 28%. That only gets you $10 billion a year. It actually doesn't get you what you need. So I'm simply showing some of the things that you can do. Yes, you'd have to raise the tax rate on the top, I think probably everyone over 200 grand, probably have to raise that to 49.5%. If you do all these things, raise the Social Security from 65 to 70. If you do all these things, means test, Medicare, if you do all these things, all you do is you get to a primary balance. What that means is you stabilize debt to GDP. You're still actually increasing your debt.
Right.
You're still actually increasing it because it excludes the interest costs, which, oh, by the way, the interest bill this year is larger than every single line item except Social Security. It's larger than defense spending, larger than Medicare.
I want to talk about why you're here, which is Robin.
You just heard Paul explain how serious this problem really is. Even if we assume that everything he outlined actually happens, all we're doing is stopping the bleeding. The $36 trillion in debt would still remain. This plan only prevents us from adding more to it. And you'll see in a bit that he sort of understands this is impossible to fix through these standard ways. If you boil the problem down to one thing, you quickly come to the conclusion that all roads lead to inflation. The U.S. government can reduce the real burden of its debt through inflation by making the dollars it owes less valuable over time. While the total amount of debt in dollar terms remains the same, inflation decreases the purchasing power of each dollar. And as prices rise, the debt becomes easier to repay because the government can pay it back with cheaper dollars. Essentially, inflation erodes the real value of the debt, allowing the government to effectively inflate away its obligations. However, while this benefits the government as a borrower, it hurts savers and those on fixed incomes by reducing their money's purchasing power. Imagine the U.S. government's debt like having a fixed mortgage payment of $900 a month. That $900 stays the same for the next 20 years. But due to inflation, let's say wages and prices go up by 300% over those 20 years. In that future, what used to feel like $900 now feels like only $200 because the value of money has decreased. The payment is still $900, but it takes up a much smaller portion of your income, making it much easier to pay off. Similarly, the U.S. government's massive debt becomes less of a burden over time if inflation reduces the real value of the dollars it owes. You can hear Paul emphasize this point in the last portion of his interview.
The playbook to get out of this, you see it in Japan right now. They have 2% inflation, 30 basis points overnight. They don't want to raise rates. The playbook to get out of this is that you inflate your way out and you have a small tax on the consumer and you run interest rates and nominal growth rate, interest rates below inflation and nominal growth above inflation. And that's how you reduce your debt to GDP. So you're going to have the Fed they should be easy. They should be
easy. You want them to cut.
So just real quickly, every 100 basis points, given where our debt to GDP right now, every 100 basis points is worth about $90 billion a year to the deficit. $90 billion. So yes, if we're trying to stabilize debt to GDP, we want to run the most dovish monetary policy that we can without letting inflation become too much of a tax on the citizenry. So yes, all roads lead to inflation. That's historically the way every civilization has gotten out, is they've inflated away their debts.